Buying your first rental property is a proven system for generating long-term wealth. Once you acquire a property, your tenants pay down the mortgage, cover the expenses, and build your equity month after month. But entering real estate completely blind carries immense risk. A single uninformed decision on a bad property can easily cost you tens of thousands of dollars and trap you with a negative asset. To prevent that, you need to rely on strict numbers instead of emotion. We are going to walk through a step-by-step mathematical roadmap. By the end, you will know exactly how to evaluate a deal so that it generates positive cash flow from day one, turning a massive financial risk into a predictable, repeatable formula. Step 0 is establishing your capital baseline. Unless you are buying a property outright in cash, lenders will require a down payment equal to 15 to 20% of the target purchase price. For a $100,000 purchase, that means committing up to $20,000 of your own money. You also need a pristine paper trail. A bank will ask to see your last 2 years of tax returns, plus anywhere from 2 to 6 months of bank statements to verify your income and track your assets. Next, find out your exact credit score. You can do this quickly and for free on sites like Credit Karma. This 3-digit number dictates your starting point and determines the exact interest rates you will qualify for. When you finally spot a lucrative property, 10 other investors will want it just as much as you do. Preparing this financial arsenal right now guarantees you can hit the ground running without a paperwork delay killing the deal. To get the absolute best mortgage rates, your target credit score is 740 or higher. Crossing that threshold proves to the bank that you are a low-risk borrower. Lower interest rates mean lower monthly payments, leaving more profit in your pocket. If you are self-employed, pay close attention to your tax returns. It is common practice to aggressively write off business expenses to lower your annual tax bill. But deducting heavier expenses reduces your official taxable income on paper. Since lenders base your loan strictly on that reported income, showing less profit directly reduces the total loan amount the bank will approve. With your documents ready, call a lender. Tell them your credit score and your saved down payment, and have them calculate your maximum pre-qualified loan limit. Securing this rigid, lender-approved budget upfront serves as your absolute boundary. It stops you from wasting time touring properties that are outside your price range, and defends against the emotional heartbreak of falling in love with a home you cannot legally afford. Now we set the hunting parameters. Plan to view between 20 and 60 properties in your area. You want to target single-family homes or 2 to 4 unit duplexes, triplexes, and fourplexes. Look specifically in the lower middle median price range, which attracts the largest pool of reliable renters. Skip the condos. Condos place you at the mercy of homeowners associations, and those mandatory, uncontrollable monthly HOA fees will continuously erode your profit margins. This calculator shows exactly how to determine a property's viability. If you buy a $400,000 property with 20% down, your base monthly payment for the mortgage comes to roughly $1,700. But the mortgage is just the baseline. You must tack on the non-negotiable carrying costs, local property taxes, which might add $400 a month, plus property insurance, adding another $150. Finally, you add the mandatory safety buffers. Allocate $200 a month for maintenance and another $150 to cover times when the property sits vacant between tenants. This gives you your absolute total monthly ownership cost. Here is the golden rule of real estate investing. You compare that total ownership cost against the rent similar places command online. If the projected rent does not exceed your total calculated cost, the property fails the math test. You skip it and move on. Your ideal investment target is a property with perfect functional mechanics, solid roof, plumbing, and foundation, but terrible outdated aesthetics. You want to avoid properties requiring expensive, invisible structural fixes. Instead, you hunt for cheap, high ROI cosmetic fixes. Ripping up ugly green carpet and painting over outdated wallpaper takes little time, but immediately allows you to charge hundreds of dollars more in rent. When you upgrade, you must renter-proof the unit. Do not install scratchable hardwood floors or easily stained carpets that require replacement after every tenant. Use highly durable, indestructible materials like tile or laminate flooring. To budget these upgrades, source at least 3 different contractor bids online. Walk the property with them, ask exactly how they plan to execute the work, and gather as many professional opinions as possible. Then apply the 20% rule.
Expect every renovation to cost 20% more than the bid and take 20% longer than the estimated timeline. Budgeting for these inevitable overruns is the only way to protect your final profit margin. Once you find a target, use a highly responsive real estate agent to submit your offers based strictly on your math. Prepare to allocate roughly 1% of the purchase price to cover closing costs and lender fees. When an offer is accepted, you enter the inspection phase. This is a mandatory forensic deep dive into the property. Even pristine, newly constructed homes contain hidden flaws, and the inspector's job is to uncover every single one of them. You then weaponize that inspection report. You use it as a second round of negotiation, asking the seller for a price reduction or a financial credit to compensate for the necessary repairs. After closing, the active renovation phase begins. During this time, you must physically show up at the property every single day. Contractors frequently overbook jobs and rotate their crews to whoever complains the loudest. Daily on-site supervision is your only defense against an empty job site and timeline delays that eat directly into your rental income. With the renovations finished, it's time to market the unit. Look at the difference here. Landlords constantly sabotage their own rental prices by using dark, blurry smartphone photos. Paying for bright professional real estate photography is mandatory if you want to command top dollar. Syndicate your listing across every major online platform simultaneously: Zillow, Redfin, Craigslist, and the MLS. You want to capture the maximum amount of market traffic possible. When inquiries come in, respond immediately. High-quality renters move fast. If you take 3 days to return a phone call, they will have already signed a lease somewhere else, leaving you with an empty unit and lost cash flow. You now possess a newly renovated property occupied by a tenant. That tenant is paying down your principal loan amount every month while depositing the surplus cash flow directly into your pocket. Maintain this property for 12 to 18 months to stabilize. Learn the ropes, build your reserves, and save your next down payment. From there, the compounding wrath takes over. If you purchase just one new duplex every other year, over a decade, you will assemble a portfolio of 10 individual cash-flowing units. By sticking to a rigid math-based system, that single initial purchase scales into an automated multi-property retirement engine. Hit the like button, subscribe for more real estate strategies, and start running the numbers on your local market today.